that is my presentation. A beautiful explosion for you guys.
All right.
We did it. Okay, I'll start. Hello everyone, it's Brad Yassar again. I'm going to talk a little bit about investing in crypto beyond equity. Because with decentralized finance and proliferation of different staking and liquidity pools, now there are other options to invest other than traditional ways. So who's Brad? I've been an entrepreneur all my life. I'm a technologist. I love building stuff. What makes me qualified to talk about investing in anything? More importantly, I've been an angel investor and a VC and had a family office for the past 2 decades, have invested in over 300 projects, 200 of them being blockchain related. The others are just early stage technology investments. As I said in the previous panel, I like investing in things that I understand and can quantify, so technology has been the main investment focus for me. Ekify is our DeFi platform, and we built the platform to actually address our own needs. Initially, with the disconnect between the banking and the crypto worlds, it was very difficult for entrepreneurs and even investors to have meaningful banking relationships and then generate value in crypto and be able to benefit from it. So we thought if we can bridge the gap, we would serve both communities, both banking clients that are more and more getting used to negative interest rates and losing their money once deposited in the bank, and DeFi projects, investors, founders, creators that are almost unbanked because of current relationship the banks have with crypto. So probably half of my slides are going to be very elementary for half of the crowd here. Those who are familiar with crypto are going to say, this is really basic, why are you talking about this? But I don't want to assume everyone has the same knowledge base. And the other half is going to be very elementary for experienced investors. And again, bear with me, I'll get to the point relatively soon. So what's an investment and how is it different from a deposit? A lot of people don't think about this. People think they're investing when they put money in the bank, and sometimes they think their investments are deposits and it should be secured and guaranteed returns, and obviously the two are very different products and services. An investment is something that carries risk. That's why it can have life-changing rewards attached to it if done right at the right time with the right project. A deposit is just an instrument that is guaranteed to a certain extent, depending on the jurisdiction, by the central bank, the regulatory environment, and the deposit-taking institution itself. Again, the difference is the risk. If you're open to risk and you want to reap the rewards, an investment is the route to go. If you're uncomfortable with risk, probably deposit instruments are better suited. So in the traditional space, I'm starting with traditional. The two most used ways to invest in anything is either equity or debt. Equity is a transaction where you purchase something, a piece of the company that you're investing in, and debt is a loan to said company without purchasing anything. Of course, there are more complicated instruments like a convertible note, which after a certain amount of time can and will convert to equity. But we won't go into those because this is more about what we can do on the crypto DeFi side. On the DeFi side, and if you guys are very experienced in this field, you're going to say, oh, you're missing a bunch of stuff. There are so many more synthetic, complicated, layered products out there. Again, I wanted to keep it very simple, more of an introduction than an expertise on the most complicated, layered DeFi investment opportunity that's possible right now. Because we saw what happens with those with Terra Luna and the ensuing carnage. But on the DeFi side, there are novel ways to invest. And this is exciting because most of these investments are much shorter term than a debt instrument or an equity instrument. I made my first angel investment probably 15 years ago, and I actually had a liquidity event 3 years ago. So I held it 12 years for about 2.5x return on my investment. And that's a win in the traditional space. I didn't lose my money, the company grew, I had an exit, I had a return after a decade and some years. If you look at any of these products, you'll see that the time frames are much quicker. So DeFi lending is the first instrument that came out of decentralized finance. And what it did was compress the process from lending being intermediated by banks, other institutions, and obviously taking their cut in the process, to programmatically connecting borrowers and lenders, and both compressing the time frame, the cost, and availability of loans. This is a really great way to invest if you're already in crypto and you have some crypto assets. It's a really great way to invest and have a return, because you can put your crypto assets in one of the platforms like Ekify. Obviously, you can choose others, and have a meaningful return on it without actually exchanging the underlying crypto asset into anything else. It's also a really good tax strategy if you want to have a liquidity event with your crypto holdings where you can borrow against them, and because you didn't sell the crypto, not get taxed. Again, this is not tax advice, but on both sides, it can be very beneficial instead of just having the crypto in a hardware wallet and forgetting about it, if you want to earn additional. Staking, very similar in nature, and it allows you to take the asset and without exchanging it or selling it, start earning something, some interest, some yield on that asset. Most newer DeFi platforms, tokens, even in gaming right now, allow some way of staking. The key here is you can keep the tokens that may or may not appreciate by themselves, but offset some of the fluctuations with the staking bonuses that you can earn. Obviously, the most important aspect and detail to pay attention to here is understanding where the rewards are coming from. Most staking rewards come from the marketing budget of projects initially for the first few years. They plan it, they build it into their tokenomics, so it's a pretty safe bet. There is always a cliff after which, if the project doesn't clearly explain where the tokens are going to come from, probably the yield is going to change or disappear. Again, this was one of the reasons, not to bash and beat a dead horse, but we didn't touch any of the Terra ecosystem because we couldn't figure out where it's going to come from. Oops. And yield farming is the latest and the greatest in DeFi products that you can invest in. This is actually the closest thing to a traditional investment because you're providing liquidity into a pool. Liquidity pools usually empower pairs for exchanges and things of that nature where there's transactional value and fees associated with it. And we like this opportunity the best out of the three, just because you will always make fees. That's what our yield product is based on. As long as there are willing parties that are trying to transact and there are platforms and pools that allow for those transactions, you know that you are going to make those fees if you're a part of that and you're earning yield on different platforms. Of course, it gets very time consuming and obviously there's risk associated with picking the right pools. And so there are platforms like ours that allow you aggregating product that aggregates the best opportunities, so you don't have to do your own research, your own due diligence on every single pair, every single pool, every single asset that you're looking to invest in. And I think that's, that's the future of probably traditional debt-based investments too. Once those are tokenized in a meaningful way and large pools created for different risk classes, we're going to see a lot of debt financing go into pools. The same way mining in crypto initially was one to network, and then it turned into a pool-based model because the returns on a single computer mining became almost gambling. There were no consistent returns. I think the debt markets are going to see a similar change where no one's going to want to just create and underwrite and deal with singular loans, even at the institutional level, and they're going to take a pool approach. So what's the biggest thing in investing? For me, it's risk mitigation. We want an understanding of the risk. We want to minimize it as much as possible, while still having the potential returns and being able to profit from them. As I said in the prior panel, I was going to save it for here, but the conversation came up. The underlying value creation is very important for me to understand. If I can't figure out how the project is going to become more valuable as a business model through their tokenomics, or the activities that they are proposing and planning to undertake, there is undefined risk that you need to consider. The origins of the expected stated returns, again, we talked about that. In any investment opportunity, whether it's equity or whether you're putting money into a liquidity pool to earn the fees and the appreciation of the underlying assets, if you can't understand where that return is going to come from, it's probably either time to do more due diligence and or talk to more experts or walk away from it. Because there are a lot of projects that are promising things without really thinking, not out of malice, but without really thinking how they're going to create that value. They're just saying, oh, we're going to return this because their genuine intention to do it. But unfortunately, without planning, it becomes a little bit of a guessing game. And of course, at the core of any investment I do is the team and their ability to deliver. I mean, we all start with good intentions. When we launch a new project, new business, everyone wants to be successful. But sometimes from the idea to execution, there is a huge skill and experience gap. And if you can identify it early with your investments, you can make that decision. Do you want to acknowledge and take that risk, or do you want to pass and go to another project? So seasoned teams, you see all these DeFi projects and companies being launched by technologists who have no background in finance, no background in banking. They don't understand any of that, and they're saying, we're going to return 4,000 APY, 4,000%. Well, that's great. Their intention is there, but they don't have the necessary skills to realize what they're saying is not sustainable and or deliver it. Best practices, always do your own research. There's a lot of marketing, a lot of third parties that are trying to sell you things as an investor. Not just only in crypto, but in any market. That's what the brokerage firms do. There's an industry around it. So again, I think it's very important for anyone looking to invest any of their hard-earned cash is to understand and do some research. I had many people come to me and say, what's happening with this token? What happened to that project? And I'm like, have you looked at their website? Have you used the product? And they're like, no, we don't care. We just want the token to go up. Well, That's not a wise investment. I'm sure no one in this room is that wanton with their investment thesis, but there are people out there who are buying just because it's digital assets and it's really easy to acquire. They're buying things that they don't understand, and then something doesn't go the way they like. And they're upset about it, whereas they could have done 5 minutes of research and say, this is not for me. The team is not there, I don't understand how it works, and I don't care how much the token is appreciating just because it's too much risk. Second one, I mean, it goes for everything. If something looks too good to be true, then it is. And I know these are very simple best practices, but a lot of the times we get emotional or FOMO kicks in and we don't think about them. And for me, one of the key ways I assess how much risk I want to take on is the expected investment horizon. Am I going to hold this 10 years, 20 years, or 2 months? If I want to hold something 2 months and I don't know how it's going to work out, I don't go in, because that's money I'm going to need in 2 months. Whereas if my investment horizon is 10 years, I'm more comfortable in absorbing some of the market fluctuations, especially in crypto where it's cyclical. So in conclusion, I think every portfolio should have exposure to some level of digital assets, whether it's through investments in pools, investments in aggregation products like the ones we have at Ekify, or single assets. I think a 5% exposure for any portfolio to digital assets is just an insurance policy, insuring the future. If your traditional holdings don't yield the results you want and you hit it big on the crypto side, wonderful. If you lose everything in the crypto, that's only 5% of your portfolio, and you'll still do well with your traditional assets. Thank you.